Hi, welcome to another episode of Talking Tax with Alex. In this episode, we're going to continue where we left off, discussing Department of Justice cases related to IRS busts on tax criminals and tax cheats. The agenda is going to be largely the same as last episode. This agenda is for the entire series. We will still have an introduction and discuss a little bit what we're doing differently in this series. We'll continue our list to summarize our cases. Yeah, there's more than one case. And items 3 and 4 and 5 on this agenda are going to be on the closing segment of this series. So what are we doing a little differently in this one? This one is different than regular court case analysis, where we look at one court case and dive into the tax aspects of that court case and the arguments and the issues. In this series, we're looking at tax crime, statute of limitations, and the Department of Justice and how they handle fraud and tax cheats. A little bit differently as well, I do have the tax court information over here that I'll be referencing a little bit so that I can read a little bit more detail about the case. I couldn't fit them all on the slide. So the first tax case on our list is a North Carolina man pleads guilty to tax evasion. So what did this guy do? Well, quite simply, he filed a fraudulent IRS W-4 form with his employer stating that he was exempt from federal income tax withholding. So what does this mean? Well, most wage earners, if you work for somebody or a company or anything, excuse me, you get a W-2, and on that W-2 you get a portion of your wages withheld for tax payments. So those tax payments count as your estimated tax payments, and if you file your tax returns, you get a refund. If we work and get a W-2 like I do, we file our tax returns, we have our standard deductions, whatever else you have going on in your tax situation, and sometimes you get a refund of those tax withholdings. In this case, this taxpayer, decided to just tell his employer that he was tax exempt from withholdings, and the IRS caught him and sentenced him. He faces a maximum penalty of 5 years in prison and supervised release, restitution, and monetary penalties. So a simple fraudulent filing of his W-4, and now he faces a maximum of 5 years in prison. It's as simple as that. Just don't claim to your employer that you are exempt from withholdings unless you truly are. On top of this, he also did not file his 2015 tax return, so I think this is how the IRS caught on to him. He somehow thought that this would never come back to bite him. Well, we can see how that worked out, right? Next on our list, so we have a hotel manager sentenced to a year and a day for filing a false tax return. So this case is very interesting. Basically, as we see here, in summary, this taxpayer used a business account on the hotel to pay for his own personal expenses instead of a wage, and then he failed to report any of the income from working at the hotel. Oops. On top of that, there was a little bit of family dynamics that came into play. His father owned the hotel, so that's an interesting little tidbit. And his father tried to influence the jury that was sentencing his son by getting the witnesses to lie to the jury. And so that became known to the jury, and let's see. Taxpayer's father obstructed the investigation into his son by directing two witnesses to lie to the grand jury. They instructed the employee to testify that the taxpayer did not work at the hotel, so to lie and say that he didn't work there. And then he also attempted to convince his tax preparer to make a similar false statement to the grand jury. So the father was trying to get his tax preparer to lie on behalf of his son as well. So there's a lot of things that went wrong here, and I guess for all things said and done, the taxpayer did get sentenced to a year and a day in prison. So that is quite a lot of time for the amount of, the amount of tax that this taxpayer issued. I mean, I guess the taxpayer was responsible for about $250,000 in restitution to the U.S. Or to the U.S. Treasury. So, the dollar amounts are fair, I guess. I'm not an attorney. I don't know what a fair sentence is relative to the dollar value, but in seeing this, it does kind of make sense, especially since the taxpayer and his father, they try to conspire and create um, a harder a harder time for the IRS to convict these guys. I think one of the one of the things I see when or one of the things I think when I see these kind of court cases is, once you're caught, you probably shouldn't double down. The next case in our list is a home healthcare business owner who's sentenced to a year and a day for employment tax crimes. So we saw in our first case where a employee lied to their employer about being exempt from withholdings on payroll taxes. Well, here this case is on the other side of the spectrum where an employer did not remit the withholdings that they took from the employee's payroll tax or from the employee's payroll. So as an employer, when you withhold those payroll taxes, you're supposed to remit those every quarter and pay the IRS every quarter as estimated tax payments. And instead, this taxpayer failed to pay the IRS at all. And instead of paying the IRS the payroll taxes that they're due, this taxpayer used the funds to pay for corporate and personal expenses. Additionally, after the IRS initiated enforcement to collect these taxes, the taxpayer provided fraudulent bank records, did not fully disclose all of the bank accounts, and filed false IRS forms attempted to use a recently formed corporation to conceal the business's operations. So the taxpayer went to great lengths to try to conceal this fraud, and I'm a little surprised at the only a year and a day of sentencing. For the amount of money that the tax loss the IRS said was 320,000. I'm a little surprised that there was only a year and a day, but in comparison to our hotel manager who also went through some additional lengths to make the IRS's job difficult and tampering with the witnesses and trying to get the preparer to lie to the jury. I guess a year and a day for $250,000 and fraudulent bank records and statements and forms appears to be the going rate. So, payroll taxes, you still have to pay them, still have to make them. Most of us are, if we're W-2 wage withholders, we don't have to worry about it. Our employer will most likely make the payroll taxes, and here's what happens if they don't. They still will get caught for fraud and tax crime. And in this case is another case of the taxpayer doubling down. They attempted to conceal what they're doing with shell businesses, fraudulent bank statements, and the like. So, once you're caught, you probably should just pay your tax. I think that might play in. Again, I play into your sentencing. Again, I'm not an attorney. I wouldn't know, but from what I'm seeing, and I think just common sense dictates, once you're caught, doubling down doesn't really seem to pan out for you. Next on our list is a Utah tax preparer who pleads guilty to tax evasion and obstruction. So this court case is very interesting. I just think it's interesting for a couple reasons. The length of time in which this tax preparer and this tax sheet issued the tax law and skirted it this is 18 years before he got caught. And he owned a tax preparation business, and he didn't file his own returns or pay taxes he owed for 18 years. Can you believe that? It gets wilder too. So, upon getting audited, he conspired with his 2 adult children to conceal his assets and income from the IRS. So, we kind of saw this in an earlier case. The taxpayer doubled down. The hotel manager and his son, they tried to conspire and tamper with some of the witnesses and get them to lie to the grand jury. Their tax preparer as well. In this case, this I mean, this criminal was a tax preparer himself, and then he started to get his own children involved. So not only did he get caught, after 18 years, again, it's not a matter of if, a matter of when, and in this case it did take 18 years, but he doubled down and he's trying to get his children to help him out and hide assets from the IRS. So really goofy all around. This taxpayer faces a maximum penalty of 5 years in prison, 5 years in prison for tax evasion, 5 years in prison for conspiracy to defraud the U.S., and 3 years in prison for obstructing the IRS. So those are all different sentences. Again, I'm not a lawyer. I don't know how that stuff actually plays out. If maximum applies, I don't know what influences whether you're going to get maximum penalties or not. But that's what he faces. His sentencing is coming up in September. So at the time of this video, I don't know what his sentence is. And finally, finally on our list, Georgia man is sentenced to more than 19 years in prison for filing false tax returns. This is crazy. So this taxpayer filed more than 30 federal income tax returns for 12 different trusts, falsely claiming $165 million of withholding. And the IRS paid out $5 million of these requested refunds. So this is on this list, I think this is the largest sentence we've seen. 19 years in prison seems quite large, but if we're looking at the dollar values here, we're kind of like evaluating the going rate. $250,000 gets you a year and a day or so. Filing 30 federal false returns for $165 million of requested refunds, actually getting paid out $5 million of those refunds. I guess we can see how the IRS and the Department of Justice came up with 19 years. And on top of that, this is all trusts from this taxpayer. And they were all basically, the taxpayer's strategy in executing this fraud was to overwhelm the IRS's system by just filing multiple refund claims. On top of that, the taxpayer used this money to purchase a new house, luxury automobiles, and to pay personal expenses. So this was definitely a taxpayer who they're feeling that they would never get caught, and it looks, as we can see, they actually got caught they actually got caught, and it's quite bad, and they're facing almost 20 years in prison for it. On top of the 19 years of prison, taxpayer was ordered to pay approximately $3.2 million in restitution, and they're going to have 3 years of supervised release after the 19 years. So this taxpayer really got what's coming to him, and honestly, I can't. It's hard to feel pity for any of these taxpayers, but this one does feel very egregious, especially when you're overloading the IRS system, getting millions of dollars out of it. I'm really glad the IRS was able to capture this guy. So that's it. That brings us to the end of part 2 of this series. As a quick recap, we looked at a case involving a North Carolina man who pled guilty to tax evasion. He did not file, or he fraudulently claimed he was exempt from income tax withholdings. We looked at a case with the hotel manager and his father who committed several instances of wrongdoing. The hotel manager himself, the tax fraud he perpetrated was not claiming any income and running all of his expenses through a business account. His father tried to tamper with the witnesses, tried to get his preparer to lie to the grand jury on his son's behalf, a bunch of bad things. We looked at the other side of the payroll tax issue on an employer who did not remit the payroll taxes that they withheld from their employees, instead used it for business expenses and personal expenses. So that's the other side of the North Carolina man. We looked at a tax preparer who skirted the law for 18 years, didn't file their own tax returns, didn't pay their own taxes, And then once they were under audit, they conspired to get their children involved to conceal income, conceal assets. They really doubled down. So this is the second instance of doubling down we've seen in this series of cases. The first one being the hotel manager and trying to tamper with witnesses and the grand jury. And our last case involved the Georgia man facing 19 years in prison for filing 30 false returns for millions of dollars to then use that money for personal expenses and luxury automobiles, etc. So, in closing, a couple of my thoughts are withholdings are still tax payments. I think it's not quite known sometimes when we get a W-2 what that means when we have withholdings taken out of our tax payments. Maybe we get it. But on the other side, employers need to pay those tax payments to the IRS too. Like there's actually money that the employers take out of your paychecks and pay to the IRS. So withholdings are tax payments. If you don't do your withholdings and subsequently, like the North Carolina man, don't file your tax return, well, that's still tax evasion. Claiming you're exempt when you truly aren't, well, that's what's going to get you caught. We saw mixing business and personal expenses several times in some of these cases. We saw the hotel manager who basically did not take any wages and spent ran all of his personal expenses through the company. We saw the employer who took the payroll tax withholdings and spent it on personal expenses. And then we saw the Georgia man who just took $5 million and spent it all on himself, which I guess wasn't really mixing business and personal. He just took money and spent it all on his personal stuff. But really, I think a good rule of thumb is don't mix your business and your personal expenses together, because, well, first of all, it's not deductible, so you're already going to expose yourself to risk that way. And it just makes for a even uglier audit when you get caught. It makes everything a little bit stickier. And from personal experience dealing with audits, I've seen personal expenses running through business accounts, and when the IRS kind of looks at it, it's kind of easy to tell most of the time. So it's really just not a good idea. I can't recommend it. It's against the law. You're not allowed to do it. So don't do it. And finally, I think this one goes without saying, don't double down. If you're caught, if you're audited, just give it up. Give the IRS what they're looking for. Don't try to hide it. Don't try to tamper with the jury. Don't try to tamper with the witnesses. Don't try to get people to lie on your behalf. It's just not going to end up well for you. In my professional experience, when clients get caught, or when they get caught mixing some business and personal expenses, when they get audited and there was truly a mistake, you don't double down. You don't try to hide it. You become forthcoming with it. You let the IRS know, and most of the time the IRS is actually pretty reasonable about it. If you're not hiding it, you're not making their job difficult. I've seen them pass on small adjustments. They might not go after small couple $1,000s here and there. They might actually just say, hey, you know what, don't do it next time. Or they might abate some of your penalties. They're reasonable. They're people too. So, but if you make their job difficult and you double down, try to hide, and make the case even harder for them, well, they're people too. And that's going to weigh into your sentencing. So that brings us to the end of this episode of Talking Tax with Alex. If you want to see the first episode of this series, please look at the link above, and it'll take you to episode 1 of this series, where I talk about the first series of cases that are in this list. And I won't summarize them here. If you like this video, or if you like this content, please like this video, subscribe to my channel, and comment or email me your thoughts. I would love to hear from you, interact with you, let me know what kind of content you want to hear. Is this kind of content engaging? Do you want a specific topic to be covered, or anything like that? So thank you for watching this episode. We'll continue and wrap up this series on the next episode. Bye-bye.